Alternative financing has been a lifeline for marketing and distribution firm Junto Stock during this pandemic. The firm distributes branded earphones, speakers, and power banks to major retailers and online platforms. With more gadgets now in demand as virtual workplaces thrive, the need to fill up stocks has become critical.
Semiconductors is shortage, so it rolls down to the end product of the consumer electronics. So we do face, longer lead times and prices start to inch up a little bit. So, we need additional funds to actually buy goods earlier or keep more stock.
Junto Stock has been tapping into invoice financing on the Validus Capital platform over the past 2 years. The financing is collateral-free and allows the firm to get paid earlier and fund new shipments, which cost around $100,000 to $150,000 per month.
They buy the invoice and finance it, and then help us to free up cash from our retail side. It's better to have a bit more on hand, plan more, rather than keeping a very, very tight cash flow.
Junto Stock is among the 30,000 SMEs that have used the financing offered by Validus. Loan disbursements grew 30 times in the past year, helping cross the 1 billion Singapore dollar mark.
Our next billion will just happen in the next year. We've kept it very basic, the invoice requirement, as well as the confirmation from the buyer. When they need a term loan or a working capital solution, we literally just take credit bureau records of the directors and 6 months of bank statement.
SMEs remain an underserved segment in the region. Of the $4.7 trillion funding gap globally, about 45% of that is in East Asia and the Pacific.
In Singapore itself, it's close to 20 billion a year, in our opinion. Indonesia is much bigger at about 160, 170 billion a year, more than 30 million SMEs across the region. So overall, I would say this probably be around the range of $270 to $300 billion per year.
SMEs that lack bank collateral and credit track records typically turn to alternative sources.
So it's really because of speed as well as all forms of short-term working capital solutions that we have such that SMEs come to us. So if you apply through our website or through our mobile app with sufficient documents, we can actually give you a decision within hours and transfer the money on the same day.
Fintech lenders can disperse up to $1 million Sing dollars in funding, but the lending cost could be higher.
There are certain niche areas where alternative finances could actually play a stronger part versus the banks. Some of these use cases include supply chain financing, very short-term loans, or what we call bullet loans, or factoring invoice receivables financing. The financing cost and interest will be about 1 to 2 times higher than most banks. For private lenders, it could go up to 3 to 5 times as higher than banks.
In Singapore, traditional banks are still the go-to for most business owners.
According to our internal data, in 2020, banks' share of financing within our platform have actually surged, while alternative lenders' share of financing dropped from 11% of total credit disbursement in 2019 to only 1% in 2020. So this likely is attributed to the introduction of the temporary bridging loan, where the interest rate was at an all-time low.
Digital lenders are crowd-funded by retail, institutional, and high-end investors. They keep default rates low by funding only growing firms rather than those in distress. The next growth phase for Validus is an expansion into Malaysia and the launch of a neobank by January next year.
Within that whole segment, we can handle your payments, we can handle your payroll, we can handle your accounting by tying up with cloud accounting software, and we can offer you loans when you need it. So it's almost like becoming a digital CFO for these enterprises that are actually showing tremendous growth.
Funding Societies has also set its sights on Vietnam and the Philippines in the next 6 to 12 months.
In the last 5-6 years, we have given out close to 2.5 billion Singapore dollars of loans to nearly 100,000 SMEs, because we do see that there's meaningful amount of cross-border trade in intra-Southeast Asia.
Post-pandemic, fintech lenders will likely play a bigger role as interest rate gaps narrow, but it will be challenging as digital banks emerge and traditional banks ramp up their online presence.
The space will be squeezed. Foresee a consolidation of alternative finances, especially the P2P platforms. So there might be some market consolidation coming up. We will probably only be left with one or two stronger players eventually.
As fintech lending continues to evolve, industry players say virtual credit cards and expense management solutions could be among new offerings.
The crux of it is really risk management, and data plays a huge part to it. And I think that our advantage is really that we have been serving SMEs unsecured financing for the last 5-6 years across multiple cycles, even through a financial crisis, and that has enabled us to train our credit model.